Welcome to the most important ever FOMC meeting. Well, until the next one happens. What is the Fed going to do? This has been the most excited people have been for Jerome Powell to speak in quite a while. As today, well, we assume and really know we're going to get a rate cut. The question is 25 or 50? We're starting to see some of these larger institutions predicting 50. We're seeing the prediction markets move up a little bit closer to 50. CME, we'll check in on that, see what the CME believes, what the Fed will do. We're going to talk about different scenarios. 25, what happens to the markets? 50, what happens to the markets? And then we'll be streaming the press conference live. We're going to get the decision here in about 25 minutes. We'll cover that. We'll look at the price action. Then at 11:30, so in about an hour, we're going to be streaming Jerome Powell's press conference live, along with some charting and potentially putting in some trades. So if you're looking for the latest on FOMC and potentially trading and making some money, you're at the right place. We're going to talk a little bit about RWAs. We're going to talk about Solana. And we just have a lot to talk about today. With that being said, Gino, roll the intro.
Hola! It's your boy Big Rob back in the house. Welcome to Sin City Crypto, where we take old, boring, and stale Fed
FOMC
meetings
crypto.
and we turn it into a fun and sexy way.
We turn it into a fun.
That's right.
FOMC City Crypto today. Huh?
Mm-hmm.
All right. Let's talk about real quick. We're going to have some dead space between now and the actual announcement, and then from the announcement to the actual press conference, which again, we'll be covering live. So if you're here, stay with us the entire time. You'll be getting our thoughts and, of course, Jerome Powell's speech. Let's start with the CME as I refresh my page here to get the most up-to-date. Rob? Oh, actually, it's gone down. I thought it actually went up. So CME currently sits at 95.8% of a 25 basis point rate cut and only 4.2% of a 50 basis point rate cut. Essentially, the CME
It's up from yesterday, from I think it was 2 days
well,
ago.
that's what I thought. But
2 days ago it was at 3.8. So
well, here it says 1 day ago it was at 5. So that's why I was looking at it. We just got a $50
we still got the nuke over there.
Yeah, my boy CPS. What is it? CLPS? CPI 674, $50. Said Jerome Powell, grow some balls, go big or go home. Hope Jerome Powell. Yeah, I agree. You think?
Right.
You think
we're gonna get multiple $50 super chats today?
I hope so.
We just starting off with a bang.
This was, you know what? Now that I think about it, this is our first super chat over $20 in like a month.
You know what? We always we're always talking about our sponsors, which we love our sponsors, but sometimes we leave ourselves out of the game. We should get some more. We got a pretty cool whale animation for our whale members. Also, gift memberships. We love those. Yeah. And super chats. What's up? How you doing? Yeah. Feeling super today. Yeah.
Yes, very super. Also, a big thank you to you, CP674. I know I said CPI. So, CME, I know, Rob, we talk about CME's never wrong, right? I don't want to say never, but very rarely are they wrong. I am sticking to my guns. I think we're getting 50 basis points of a rate cut. I spoke to Magic about this yesterday. I said, listen, I know, and Magic's thing was, I don't think Powell's going to bend the knee to Trump. I said, I don't think it would be a bend the knee to Trump cutting 50. I think it's as simple as, hey, we didn't cut rates 4 months ago because we assumed there were 1 million jobs. Now we know that there are not 1 million jobs, so we're just making up for what we should have done if we had the right data 4 months ago. That's what I personally think is going to happen. Is it probable? In my opinion, yes, but to the outside world and literally everyone else and everyone tracking, the answer is no. Do you still stay and stand on the side of 25 basis points for a cut?
Yes.
Yes?
And it's not even, I'll be honest with you, it's not even from the CME's perspective. It's just that Jerome Powell has been stubborn and has prolonged any cuts up until this point. We've had some cuts earlier in the year, like almost at the beginning of the year. And so, here we are at the end of the year almost, and well, now we're finally getting another cut. And so I think it's not so much, hey, the CME is confirming it. It's more like, hey, Jerome Powell's just stubborn. And for some reason, the man don't want to lower rates. And finally, he's getting so much pressure to cut rates. And other Fed chairs are influencing his decision. The votes are getting closer every time that they have a meeting, getting political pressure from the executive branch. And so they're forcing him to. So now that they're forcing him to, he's going to be like, fine, I'll give you 25 basis points.
So you don't think he would have cut 25 on his own? I think he would have, man. Look,
I think there's a lot of semantics here on he could have, like, there's a lot of, like, that's like erasing half of the past. Like, I don't know what he would have done if there was no political, I don't know. But how we got here, the dude just hasn't wanted to cut rates. He hasn't been talking about it. He hasn't been saying, hey, like, we're looking at it. Like, he's just been, everything has been defensive on not cutting rates all the way up until this point. And then finally he was all like, yeah, I think maybe it's time. So okay. So explain the thought process of getting that revised jobs report where 1 million jobs were overstated, Rob. You don't think that's going to have any sway on what? Not, and remember, this is a committee decision, correct? This is not just a Jerome Powell unilateral decision. Let me tell you something. These numbers, you love looking at those numbers. You love analyzing them and then using it as a backstop to.
Why do you say that
reasoning.
as a bad thing?
I do my
research.
I'm not saying it's a bad thing that you do your research. All I'm saying is that, okay.
Is you don't like research.
Let's just say,
Rob
hey,
doesn't like
hold on.
No.
Give me a second. Let's say you have a girlfriend and relationship is rocky. She's always mad at you. You can't do anything right. And y'all on the verge of breaking up, you know it. And then she dumps your ass. And she says, it wasn't working. It was, the fact is that you always leave your underwear on the floor and you don't put it in the hamper. And I asked you to do this. And the thing is all those excuses are relevant. That's just wordplay. It wasn't going to work out anyways. If you would have had your underwear in the hamper, she still would have left your ass. What I'm saying here is that he wasn't ever going to cut rates no matter what the data said. It's just the reality of it. He uses them as excuses. Just like the girl, she didn't want to be with your ass anyways. And she's just giving you the lip service excuses. Like, let's just be friends. You know what? Like, everything was a lot cooler when we used to hang out before we started dating. Like, it's all excuses. The reality of it is, if in the relationship, if it wasn't going to happen, the sparks weren't flying, it wasn't natural, they're going to give you excuses. They're going to point to numbers. And that's the reason that she's going to say there's a breakup. Same thing for Jerome Powell. Dude is sitting here. He don't want to cut rates. And every time there's some analytics or some numbers, or, he pushed the tariff causing inflations for like 4 months. And what happened to inflation? It didn't go up. And then finally he was like, all right. Jobs, jobs. That's the next one. Like, I'm telling you, bro.
The jobs numbers are bad.
Exactly. So what I'm saying is that, like, the analytics, the dude don't want to cut rates. He's in a stalemate with Donald Trump. The two are bickering back and forth. He doesn't want to cut rates. Donald Trump does. Donald Trump calls him stupid. He's like, okay, call me stupid. I ain't cutting rates. And now here we are. That's what has happened. I look at it from a perspective of reality, not of analytical data.
Who left you for leaving underwear on the floor?
Yeah. You got some hate in your heart there, my friend? The worst is when the girl would say, we just have such a good friendship, I don't want to ruin it. And then you get with someone and then she comes back and says, hey, I really like you a lot. That's happened to me a couple times. Anyways, I got a poll up, 25 or 50 right now. We're going to keep this poll open for a little bit until obviously the announcement is made. 70% of you believe it's 25 and only 30% believe it's 50. So to the 30% of you, now 31, that agree with me, I hope it happens. Now, let's play out a scenario, okay? Rob, we have Bitcoin small rally, 116.074. Let's actually go to a Bitcoin 5-minute chart.
A lot of volatility leading up, man. You know, I saw yesterday.
Look at this real quick, Rob. Look at the spike in volume. So we're seeing some movement, which we told people. And by the way, I went into my open trades and I made sure that I had the proper stop loss in and I had some TP level set. So if you haven't done so, I would highly recommend. No one knows the way the markets are going to go. My feeling is 25 basis point rate cut, the market's dumped. 50 basis point rate cuts, we get a big rally, and then the market dumps. That's my personal opinion. I don't know if it's going to happen. I'm not saying it's going to happen. That's just what I think. So if we get the 50, great. I have my TP level set. If we don't, I have my stop loss level set. And we take an L, we take an L. That's okay. We move on to the next one. So Bitcoin seeing a large spike in volume on the 5-minute chart. A little bit of a W pattern here on Bitcoin. Also a little bit of an inverse head and shoulders on the 5-minute chart. As you're seeing, it's starting to break out just a little bit. If we zoom out to maybe the 30-minute time frame, Bitcoin did reach as high as 116.3 not too long ago. And we're seeing not only increasing volumes on the dips, but increasing volumes on the price action to the upside as well. And so, again, expecting lots of volatility. So, do you agree with me that if we get 25 basis points, Rob, that A, it's already baked in, and 2, we're going to see the markets pull back?
I think the markets will bounce up and down. I know this isn't what you want to hear. I think we'll if the
after the announcement is made.
After the announcement is made, I think that what you'll see is Bitcoin. It's currently where at 16. I think Bitcoin will probably rally to 117.8, pull back down to 115.
This is after a 25 basis point rate cut has been announced. Okay.
Yeah, so I think you're gonna bounce around between 114 and 117. And I don't even think it gets down to 114. I think you go 116.8. I think it's going to be 116.8. Maybe we briefly get into 117.5, and then we come right back down to 115. And then, yeah, I think that's what we'll see.
Alex Crypto, not Alex but Alex Crypto said rate increase and mic drop by Powell.
Also, Jessica said, you said, what did she say earlier? She said, she wants to be your girlfriend, not your mother.
Fair enough. That's a fair point.
I need a kind, caring woman that will pick up my underwear.
Wow.
Huh?
Okay, so
My hand slipped. Sorry.
So we get volatility when the announcement happens, correct? And then it's a little bit of a lull, and then the press conference, and we see more volatility. You think we'll see more volatility? I know I'm asking a lot of hypotheticals here, but this is what people want to know. Volatility, you think we'll get more between the announcement and the press conference, or more during the press conference?
I think more during the press conference.
I agree.
Yeah.
I agree, because they're going to be hinging on every word. Is he going to commit to another rate cut the next month for the meeting? Is he going to do it? Is he not going to do it? How dovish does he sound? And then people are going to extrapolate that and say, okay, well, damn, sounds like he's going to cut 50 next time. Sounds like he's going to cut 25, or doesn't sound like he's going to cut at all. If that's the case, if Jerome Powell comes out, and I'm speculating here, if JP comes out and the tone is, we cut, we're going to wait, I think the market's done. I think Bitcoin goes back down to that 111, 110.
I will say, though, if you do get the... Well, no, that's not happening.
Okay.
The lowest we'll see is 113, man.
The lowest? You think the lowest we'll see is 113?
Yeah.
Even if he cuts 25 and signifies that they're going to pause.
Unless there's some kind of pause, and in that point, you would see less than 113. But that's not happening.
It wasn't long ago when we were at 109. You understand that, right?
It wasn't long ago. We were at 124.
Longer at 120 than we were at 124, then we were at 109. So, I don't know. I think
we were at 109 at the beginning of the month, right? At the end of last month. And so this was the bottom, dude. We're not going back down here. Unless the unthinkable happens, and
Which is what? Okay, what's the unthinkable?
And we got to pause, but
this we're not getting a pause.
I know we're not, but I'm just saying that's why I said the unthinkable because I can't even think of it. Come on, man. No, it's plain cut and simple, man. The numbers come out. We go to 116.4. When's the numbers come out? In 10 minutes?
Yeah.
We go to 116.4. Then we pull back down to 115.5, right where we were when we started the damn show. Then the press conference starts. Then it moves up and down. I don't know which one's going to happen first. Depends on what dumbass words come out of Powell's mouth. And from there, we'll bounce and ping pong between 117.4 and 114.2.
117.4, 114.2.
Yeah. That's a lot of volatility, man. Big swings.
Yeah.
Over the course of, an hour, that's big swings, man.
Okay. Well, there's one company who's never wrong. Just kidding.
But what happens if they do get the 0.5 basis cut?
The 50?
Yeah.
Big rally.
Yeah?
I think so.
What do you think happens? Where do you think happens to Bitcoin's price?
120, 121.
120?
Yeah. I do, man.
Over the course of how long?
Over the course of until he speaks. Bro, I mean, you've been in crypto a long time, bro.
I'm not saying it won't happen.
You know how leveraged to the tooth Bitcoin is.
You're just pretty conservative, man.
Rob, we hit 117.5, 118. Shorts get liquidated, pushes the price up to the next level. Those get liquidated, pushes up. It happens very fast. And I think if we get 50, okay, let me show you something very interesting here, Rob. Look at this. When the Fed cuts rates with stocks within 2% of record highs, the S&P 500 finished the next 12 months higher every single time. 100% win rate, 20 out of 20 times, Rob, going all the way back to 1980. Going back to 1980, Rob. Percentage away from all-time high in 1980 was 0.59%. The following year, S&P finished 7.6% up. The biggest year was in 1986. The S&P was 1.94% away from all-time highs. That year, the S&P finished up 33.2%. 20 out of 20. Is that a coincidence? I don't think so.
You can't say coincidence on 100%.
True.
unless it's one singular event.
It's fair.
Hey, last time I crashed my car happened to be a full moon. Like, okay, that happened once. But you're 20 out of 20 at 100%. Coincidences are out the window at this point.
But what are your thoughts on this?
At this point, it's factual.
I know you're not a big data fan, but what are your thoughts on this, man? I mean,
it's straightforward, man. You can't even argue with it. You can't go on the other end. It's just reality.
The S&P's at all-time highs.
I know, dude. Things about to get real cray. We about to make some stupid money out here, man. Because crypto's about to take off. Gold is up in all-time high. Bitcoin near all-time highs. Just set one a month ago.
Not even.
And Fed is cutting rates. We got ETFs about to drop for altcoins, right? That is in 3 weeks. You're going to get Litecoin, then Solana, all in a week. Things about to get real nice. And then the rest of October, another like 5 altcoins. XRP's going to have an ETF. So basically, you're in all-time high territory in the stock market. What happens when the stock market's in all-time high territory? People are in profits. People are moving, or rebalancing portfolios. They're taking more risk. They're buying crypto. And where do you buy crypto? Well, historically, you used to buy it on exchanges. Now, if you're a publicly traded company or you're just an investor, you're in crazy profits, you're in money, you're rebalancing, you're moving money around. Hey, look, shiny new product. It's available on Wall Street. Let me get exposure to Bitcoin, ETH, XRP, Avalanche, Cardano, Litecoin if you want it. And it's about to get fun out here, man.
You think so?
It's about to get real fun. I was on this train yesterday, dude. We hang out. You. Yes. Hi. Hello, person on the other end of the phone. Look, you watch these shows every day. You look at your portfolio probably every morning or every night or whatever it is. Take all your hard-earned extra money, you buy crypto, and your friends and family don't really understand you, and you try to convince that one guy at work to buy some Bitcoin or Ethereum or something, and they just don't pay attention. All of this time, this 3 years of being in this solitary confinement of, you know what the hell you're talking about, but it hasn't been proven because altcoins haven't ran. It's all about to come true. It's all about to change. And the time is now, and right now, we are about to be crypto millionaires. Congratulations. Thanks for waiting.
Dadbod said, why can't they cut like 32 basis points or 38 and be more precise? Increments 25 don't make sense. It's two-factor. One is messaging, right? It's got to be a clear message. It's like nice round numbers. And number two is you look at all the lenders, the mortgages, the credit card, and people borrowing, lending money. It's in 25-point increments, and so that's really where that comes from. But I think it's an interesting question that you asked. Okay, so Standard Chartered. Right, Rob? These are the guys that always come out with a crazy-ass Bitcoin price. Bitcoin's going to hit $1 million in 72 hours. They're thinking the Fed's going to surprise the markets with a 50 basis point rate cut. Also, Matthew Moore said, Rob, please stop yelling. He's at work. He doesn't want to get in trouble. Don't get our boy in trouble and get him written up, all right? Tone it down a little bit. Matthew, I got you, bro. Thank you very much. And so Standard Chartered believes, obviously we see arguments on both sides, but a vast majority of people believe it's going to be 25, which, again, we're going to get in 4 minutes. Rob, if you want to keep your eye, pull up CNBC. Once it hits, it should be the very, very top news story. And then once it hits, when you see it, brother, cut me off and let's break the news to the people watching. But this has been, and I mentioned, the most significant rate cut in terms of people wanting to know what's going to happen and, well, what are they going to do? Polymarket for today's Fed decision has surpassed $200 million in volume, making it the largest FOMC prediction market in history. And again, rate cut decision, 3 minutes. You have the press conference in 33 minutes. We'll be covering those live right here. So if you're here with us, welcome. Stick around. We're going to be covering it live while Jerome Powell is speaking. He's going to speak uninterrupted. We're going to have some charts to show. And if you'll see if we happen to put any trades, you can follow those as well if you'd like to. And so you also have this. This is interesting. There's a 98% chance Jerome Powell starts today's FOMC press conference with good afternoon. The last time he skipped the good afternoon, Rob, the Dow plunged 800 points.
Now, you want to talk about coincidences?
What a coincidence.
The other data you had made so much sense, and then you just reach for God knows what.
Polymarket. I'm just sharing news, man.
Come on, dude.
I'm just sharing news. We also have this. $2 billion of stablecoin inflow was recorded ahead of the Fed's upcoming rate decision. And Rob, going back to February of this year, this was the highest inflow, Rob, in a single day. Look at this chart, my friend.
Wow.
Highest in a single day. Is it a coincidence that it happened right before the FOMC? I don't know,
man. That looks like...
Let me ask you this question.
That looks like my EKG before I start the show.
Is this...
The heart is pumping.
Is this a coincidence, Rob? Someone just bought $680 million of Bitcoin ahead of today's Fed rate cut decision. Is that a coincidence? These guys know something we don't know. We're going to get a 50 basis point rate cut. Please, God, let me go to here and don't say it's only 25. I want to be right so bad that it's wrong. I want 50, and I think this just signifies me in a nutshell here, my friend. Our parents in their 30s, let's buy a house. Us in our 30s, I need 50. Give me the 50 basis point rate cut, please, for the love of God, Jerome Powell. Help us. Unlock the liquidity. Send the money market funds into crypto. $8 trillion. Yeah. We got an announcement yet? It's 11.
Not yet. No.
2 p.m. Eastern. It should hit right now. Right now is when it should hit. Come on. Give us 50. S&P just turned green. Dow is up. Damn it.
Quarter.
Okay, fine. I'll be wrong.
You can want it, but you know you ain't getting it. It's like I was a
ways
kid.
than you know, my friend. More ways than
I was a kid. I was like 8 years old. I asked Santa for 52-inch big screen television.
You got a 24-inch?
I got no television.
Wow.
I went too big, man. I was hoping. I knew it wasn't reality, man.
It's kind of sad.
Just because you hope don't mean real.
It's kind of sad. So the Federal Reserve on Wednesday released a decision on interest rates and updated its economic projections. Now, that's going to be the important thing, my friends. Updated their economic projections. That is what we're going to hear from Jerome Powell in 30 minutes, which we'll be covering live right here. In the meantime, I'm going to go ahead and end the poll we had because, well, now that we know what the answer is. So now it's well, what are we going to see? Let's take a look at Bitcoin on the 1 minute time frame. You saw the big pump about a minute ago, and on this 1 minute candle, we got to as low as 115.7, currently trading above 116. Let's take a look at some of our indicators. We have market cipher B pulled up here. We just get a green dot and an extending momentum wave. On market cipher B, you are seeing our momentum oscillators start to dip. So, I don't know. I mean, the 1 minute tells us it's where we're down, and there we go. We're starting to see 115.877 and dropping. Let's throw on market cipher A. See, we did get a blood diamond a few minutes ago. Again, guys, this is on the 1 minute time frame. If we go out to maybe the 3 minute time frame, 3 minute looks good. Let's check the volume on let's check market cipher B on the 3 minute. Across the board, when you look at these oscillators, 1 minute down, 3 minute down, 5 minute as it loads. 5 minute looks like we're catching a little bit of steam. 5 minute also down. 10 minute also down. I'm just kind of cycling through. 15 minute looks like it wants to turn, which means a 1 minute's probably starting to turn or is going to turn here in a second. Did just get a red X. That is your first signal to get out of the markets. As you can see here, a lot of volatility from 116.1 down to 115.6 and then right back up from 115.6 up to a high of 116.3. Currently, Bitcoin is trading at $116,104. It is starting to rally. I do want to pull up the crypto bubbles. We could take a look on the 1 hour, what's going up. A lot in the green as of right now. You have Pumped Off Fun is up, Maker is up, Meme Core, no idea what the hell that is. Still, probably should look into that because I keep seeing it pop up. 116, and now we're back down to 115. Let's take a peek at Ethereum. See how Ethereum is performing. Ethereum is actually down on the 24 hours. You can see very similar, obviously. That's what you see across the board in really all of crypto is when one thing moves, the other moves almost identical to it. We can take a look at market cipher B to just get a green dot with a VWAP crossover on the 1 minute time frame. So could we see a little bit of an extension to the upside momentum oscillator, our momentum indicators look fine. That is looks like our stochastic and our RSI are bunched together, so some confluence there. 4,500 for Ethereum. Let's check in on our trades. We are currently 33% in the green on Cardano, and I know ENA was down around 45% yesterday. We are currently in the green right now as well. I am not looking to enter any trades right now. Now, again, during the actual press conference, I will have both my trading platform and, of course, TradingView up. We hear something, we see something that is, that would potentially be an opportunity for me to go ahead and trade. Rob, no clear indication of the direction the market is going. I know Alex was on the show Monday. He said usually the first direction the market reacts is a direction it will continue. You will get a little bit of a move the opposite way, and then eventually it comes back down and goes the way it started to go, which means if that is true, on the 3 minute, which to be fair to Alex, he said he uses the 3 minute. Alex, if you're watching, feel free to chime in the chat. 3 minute shows that the first move was down. So if you subscribe to Alex's idea, Rob, the continuation should be to the downside. What are your thoughts on what we've seen so far? Again, Bitcoin at 116.1, Ethereum at 4507. What are your thoughts?
Well, I mean, what were the probabilities here? You had two options, right? You had 25 basis point, and then you had the 50, right? The 50 basis point was a long shot. So there were some people that I'm assuming put in some long positions that were preparing for the market to move straight to the upside if there was a 50 basis point move. If people thought like you did, where you thought that, hey, it was an actual realistic possibility, we could see this, and, people were taking positions to do so. And, well, that didn't happen, so I think you get a sell-off. It wasn't a dramatic sell-off, right? It's like, hey, this is what's expected. Small percentage of the people out here, small percentage of the traders were preparing for a 50 basis point rate cut, even though it was less probable. That didn't happen. Had a little bit of a sell-off. But, hey, look, the reality of it is that the Fed is cutting rates. This is going to be bullish for crypto, and people recognize this. And even at its current price at 116, this is a great entry opportunity if you forward look. I'm not talking forward look 2 months, 3 months, 6 months. I think if you just forward look 4 or 5 days from now, by the end of the weekend, I think that we're going to be back around that 120 position. And I think that, hey, you know what? If all I just need is that confirmation that we get the 0.25 basis rate cut, and then at this point, now let me enter into the market. Let me put in a trade position. Nothing freaky is going to happen here. Now, you do have the risk of the meeting coming up on the backside of this announcement, and Jerome Powell being bearish, saying like, "Look, we're not going to cut anymore," or maybe just says something that catches us from left field, and we're just like, "Hey, the market's going to sell off." That's always a possibility, although unlikely. I think that what you're seeing now is that people entering into trade positions that are forward-looking into the week, or just people loading up on crypto. They're just kind of bullish just in general. Also, if you take a look, the Dow Jones is up 1% currently. S&P 500 is pretty flat too, and NASDAQ is down just 0.2%. So the markets are relatively flat, the exception of the Dow Jones Industrial Average. And it's interesting. I think what we're really waiting to see is the press conference, what comes out of it. I do think that we will kind of hold right around the 116. I kind of said this before we even started. I said that we'll probably see a little bit of volatility once the numbers come out, but I think we'll hold in around a 116. I think the real volatility will come here in the next 30 minutes once we get Jerome Powell at the podium. And I do think that at the 0.25 that we said we were at, I think that this right here is going to bring in that small volatility, small or large, depending on how you see it, between 117 and 114. And maybe I'm wrong, but I think that's where we're going to land.
So let's take a look at the changes in the Fed statement. So what you see crossed out in red is what they were going to say, but they didn't. And then what you see underlined in red is what they actually added. So the initial statement was, although swings in net exports continue to affect the data, they struck that out because swing in net exports. So they said recent indicators suggest that growth of economic activity moderated in the first half of the year. The job gains have slowed and the unemployment rate has edged up, but remains low. Look at what they removed, Rob. Initially, they had labor market conditions remain solid. That was scratched out of the updated statement. Inflation has moved up and remains somewhat elevated. So I think you have a little bit of both dovish, hawkish, dovish, hawkish. Hawkish in jobs have slowed and the unemployment rate has edged up but remains low, right? That is your kind of dovish. A hawkish, inflation has moved up and stayed somewhat elevated. So then it's going to come down to, is he going to pick, what's more important to Jerome Powell? Is it jobs or is it inflation? Right? Is it jobs or is it inflation? Because you have both moving up, unemployment rate moving up, inflation moving up. You got to make a decision. You care more about the jobs. You care more about inflation going up. They did move their inflation target up from 2 to 2.5, correct? Their baseline inflation target. Okay. So to me, that says they care more about jobs. That's where I take from it. What are your thoughts? Do you agree? They didn't move the goalposts of unemployment rate. They moved the goalpost of inflation and CPI.
Well, the thing is that people will go back to work. People will get jobs. Inflation's not coming back down under 2%. Not in the way that the government is run. Not in the way that the current system is set up. And so the days of sub 2% CPI number, which, by the way, was cherry-picked number, which probably never was under 2%, at least not since the 80s. But that number's far out there. It's a reach now, man. And I just don't think, I think that the Fed just realized that, like, we're not bringing inflation down there. And so you from their perspective, you got to move the goalpost. And then on top of that, the jobs, well, that's a number that will actually move. People will go back to work. People will take new jobs. The job market will grow. And so because that is something that you can actually strive for, then I think that's why it's there, right? I mean, do you think we'll get under 2% of CPI number anymore?
Maybe in a few years when AI is here, but I don't know. I don't think so. In the short term, no. That's why they moved the goalpost up.
Yeah, I think it's possible. You know, I think it's likely that we do get some prints in the future, but it's not going to be sustained. I think maybe we get like 1 or 2 quarters sometime in the next 5 years that are sub 2%. But the days of multiple years at sub, that's gone, man.
I do want to get back to this because the Fed statement, and again, guys, in about 18 minutes, we'll be streaming Jerome Powell live right here. So if you're here, don't go anywhere, stay here. If you want to see Jerome Powell speak. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of the dual mandate, and they added this, and judges that downside risks to the employment have risen. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower. They were going to maintain it here. Lower the target range for the federal funds rate by a 0.25 percentage point to 4 to 4.25. In considering the extent in considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Now, I know I'm kind of like really, really being picky here, but what does he say first? He mentions employment first, which is why I'm a little surprised they didn't go 50. Employment. Oh, and inflation, and inflation, and inflation. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that can impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, again, listed first, inflation pressures and inflation expectations, and financial and international developments. Well, international developments are everyone's been cutting for the last 6-7 months, and well, we just started cutting. So, Rob, anything else you take away from the statement here of Jerome Powell and the Fed?
No, this is the typical press release. So,
okay. All right, let's take a peek back at BTC. Bitcoin currently seeing a little bit of a dump here, and let's go full screen Bitcoin. ETH also below $4,500. Bitcoin at 115.4. This is on the 3-minute time frame. And you can see, to Alex's point, drop move up, and then currently dropping 115.1 and dropping, right? So let's go to the 1 hour time frame. 1 hour, let's look at see how oversold we are. We're about to hit, we're at 33 on the RSI. We're about, I expect to hit severe oversold levels here on the 1 hour. Let's take a look at the 30-minute. 30-minute, we have hit oversold. 114, we are officially below. Oh, that was
I think we're going to get a nice little bounce right here.
So let's throw on a couple of indicators here. Just taking a look at some price action on BTC. Let's throw on our high volume points. See where the bids are coming in, where the buyers are stepping in. There's a large amount of buyers between 114.4 and 114.975. As you can see here, that wick down to this high volume point where around 600 Bitcoin was bought on Monday. This is on the 30-minute time frame. Monday at around 9 p.m. We do have a larger volume node down here at 114.5, 114.415. I'll drop a flag here. 1,200 Bitcoin was bought at 114.421. We're already seeing a little bit of a bounce. 115.4 has been a level that I've identified on the lower time frame here for Bitcoin. We can move back down to the 5-minute. Got a blood diamond on market side for A on the 5-minute. That's typically not good. We see how blood diamonds play out. Blood diamond and Bitcoin drops around almost 0.25%. Now remember, this is on the super low time frame. And so we'll see how this candle plays out. But if this candle closes the way it is now, let's get rid of this indicator here. This would essentially be a hammer candle at the bottom of a downtrend. And so this should signify a reversal. What I'm also seeing that I like is each volume bar, this increased by looks like around 50%. This increased by looks like around 25%. And you see the indecision in the markets. Large wick to the downside, large wick to the upside, and price closes somewhere around where it opened. Rob, let's take a look at the altcoin markets. And if you got your eyes on any other breaking news, love to share that as well. But I'm curious to see how some altcoins are performing. Are there any sectors that are taking a big beating?
Right now, there's not much up, and at least not compared to what's down. MYX Finance up 60%. Not familiar with that. But everything here is kind of hanging out around the 5 to 4% on the upside. And it's not even more than the top 10 that's up more than 1%. So once you get outside the top 10, everything else is red. So most of the altcoin market is red today, but not by much. And so I wouldn't freak out here. I do think that we're going to get a nice little bounce on Bitcoin. And if we can close the day out around that 116 to 117, I think it signals to the altcoin space it's time to rally. So taking a look at what's down today, you got Monero, Pump.Fun, Toncoin. A lot of this was up.
You're saying earlier. These are up or down?
These are down. But a lot of these were up earlier in the week. You still got Pump.Fun up 40% on the week. And so Pump.Fun has been absolutely killing it. There's been a lot of streamers on Pump.Fun lately, so it seems to be catching that similar buzz that it had at the beginning of the year. And then also you take a look at, Aerodrome is one of the channel favorites here. This is one of the top performers today and also up 11% on the week. Immutable X is up 32% as well on the week. So you take a look at what is not doing well on the week. You got WorldCoin, Athena, Kronos, and these are all projects that did well earlier in the month. So we're just seeing a little pullback. So it seems like altcoins are kind of hanging out on the sidelines, waiting for Bitcoin to find itself. And then hopefully what we'll see is Bitcoin getting back up into that 120 range and consolidating. And if that happens, then, well, we'll see that big altcoin push again. What we don't want to see is Bitcoin down to 110, 109, 109, because then I think the altcoins will stall. Some of the ones that have gained a lot of percentage, say in the last few weeks, will probably give a lot of that back up. And so we'll be curious.
Interesting, right? Remember Trump just put in a new Fed governor? He was the only one that called for a 50 basis point rate cut. Everyone else said 25. So you have been saying the next Fed chair is going to come in and just start slashing rates, right? Also remember, in January, the FOMC rotates. So the presidents or the governors, the presidents of each different Fed chapter, or right, like the Atlanta Fed, the Philadelphia Fed, they rotate. So the ones that are in now are out, and the other ones that are in rotation are going to be coming in. And so that dynamic will change. I'll have to do a little bit of digging on that as far as who's coming in, who's going out, who's more hawkish, who's more dovish. But you also had, there was another article on CNBC stating that they're expecting 2 more rate cuts this year. So a rate cut at every single meeting, September, October, December. Now the question then becomes, okay, is it going to be 50 or just going to be 25, 25, 25 to end the year? And then what happens after that? Is it a pause? Is it more rate cuts? Again, to Rob's point, I do think whoever comes, I mean, here we have Exhibit A. His first appointee said, we need to do 50. Everyone else that's already been there said, no, 25. And they obviously went with 25. So yeah, those are my thoughts there. Just checking in on Bitcoin, 115.4. So like mentioned, I asked Rob the question before we started the show. I said, do you expect more volatility after the announcement or during the press conference? And I said during the press conference, I think is where we're going to get. Realistically, when you're measuring volatility, right, wick to wick, this is 1%. And I know it's in a very short time frame. It's in about a 15 to 20-minute time frame.
I want to know, I know we've kind of talked internally here on Bitcoin's price action during the press conference and subsequently after. But I'm curious what you, the viewer, here thinks. Let's get participation. If you're watching there, press a little up arrow under the video and bring up that keyboard and hit a comment because we want to know, where is Bitcoin's price going to land by the end of the show? We're going to keep it simple. It's going to be 1 and 2. Do you think it's more likely to be at 118 by the end of the day, or do you think it's more likely we'll be at 113 by the end of the day? I want to know. Put a 1 for 118. Put a 2 for 113. We want participation from all of you. All 300, however many of you are watching, join us in our discussion.
So end of day or end of the press conference?
End of the day. End of the day.
Okay. By the way, guys, we got the press conference queued up. As soon as Jerome Powell starts talking, we'll cut to that. Should be in about 8 to 10 minutes. We'll be covering that live. And again, we'll be sharing some charts and potentially some trades as well. Okay. So let's step away a little bit from the Fed right now. Let's talk some alts. And then as soon as Jerome Powell starts talking, we will cut to his stream live. So let's talk about Solana. We're getting a lot of 2s here, my friend. A lot of people are more bearish than bullish. So we'll see. We read the Fed statement. We'll see what Jerome Powell actually says. Forward Industries, the largest Solana treasury company, has launched a $4 billion at-the-market equity offering program to fund its Solana strategy, working capital, and other growth initiatives after recently purchasing 6.8 million Solana. And then that was reposted by Mike Dudas. Dudas. It's a cool name, man. This is more than 3% of Solana's current market cap. The ETF is rumored to be coming next month. A few more large digital asset treasuries, including a monster one. Imagine thinking we've topped. I know that's a lot of people are saying, oh, the top is in. We've been pretty adamant about the top not being in. And it's partly because of reasons like this. You just can't look at what is actually happening and say, well, no, the prices are going to keep going up. At some point, it has to, unless there's some shady shit happening, right? Unless it's like paper crypto they're trading, paper Bitcoin. I know we have OTC, but the last buy was not OTC. It was $1.5 billion Solana that was bought on the open market, which directly affects the price. So keep that in mind. You also had this here. So there are now over 100 million tokens. Think about that, bro. In all of crypto, there's 100 million tokens. And 85% of them are Solana. A lot of hate on this here, man. 99% trash. Solana running the token daycare. So you admit Solana is just a token database, just a casino, nothing else. 98% of them are useless. And obviously you have some good comments as well, but
it'd be great to pull up some archaic numbers on media and how people like consume their news, and then just talk about the internet when it first came out, and then be like, hey man, there's like 99% of the websites nobody cares about. It's all scams and nobody cares. And it's just all about this. It's just trash. It's just filler. Just a bunch of domains that people bought up. Like, it's all fake. Like, yeah, but you know what? That's where people are going, right? Eventually people leave this archaic system, which is a newspaper. You had to wait till 7 a.m. for somebody to throw the news on your doorstep. Now, like, you just wake up and you open up one eyeball and you start scrolling, you're getting all your news. It's obviously a lot more efficient and a lot better. It's the same conversation you're going to have with your kids and grandkids. Like, man, you know what? I used to swipe my credit card. It used to take me 3 days for that thing to finally settle. Just kept saying processing. Like, you know, I had to pay $50 to send Gam some money through a wire transfer back in 1995. Like, the thing is, like, this thing just makes no sense. Like, yesterday I had to do a credit application and I had to submit a voided check. I called David. I was like, David, do we have any checks? He's like, hell, no checks. like, who takes a check and then writes void on there? Like, come on, dude. The system we have is so broken, outdated. And so, yeah, you know what? The most popular network, the one that everyone happens to go to when they want to launch something, is Solana. How many domains are listed under, you know, the largest platform, right? You can say there's a ton of scam domains, but the reality of it is, where's the traffic? That's where you want to be, right?
This is where I want to be, right here with the traffic.
You can talk all the crap about a large city you want and talk about how bad the traffic is, but would you rather live in some small little town? I'm not saying there's anything wrong with small town. I came from a small town. But if you want to be where the people are, you want to be where the innovation is, you want to be where the jobs are, you want to be where people are growing, where there's opportunity, you want to go to the big city. It's the same here when we talk about tech, right? Do you want to be on some small little network that only has a small core developers and a small community? And it's like, sure, maybe you got this little camaraderie that you have with your little homies. You're like, our chain is the best. It does the most transactions and it does this, and it takes the 3 pillars of decentralization and security and scalability, and we actually added a 4th pillar, which was awesomeness. Like, it's crazy how people just get behind the numbers and talk crap about traffic, right? Yeah. I don't know. Anyways, I'm super bullish on Solana. End of the day, I am about as bullish as it gets on Solana this next 3 months. By the end of the year, I think Solana is going to have a big breakout. I said it yesterday, Solana winter is coming. I think that 700 and beyond dollar Solana is coming. Meme coins are coming back. It's going to be driven by Solana. That right there says it all. I think that let me ask you a question, David. If meme coins pop off, become crazy again, which they will pop off and go crazy again, just will it be now or later? If that happens, what ecosystem is it going to be on?
More than likely Solana.
There you go.
I do want to give a big thank you. Today's show is brought to you by the #1 social casino in the entire world. That is stake.us. We love Stake. Don't roll the ad, Gino. I see Jerome Powell. They just cut to the feed. We love Stake. Big thank you to them for being a channel partner. So Jerome Powell, Rob, if you want to pull that up, they did cut to the feed. And so if you go on, I think YouTube might be better, Rob. It should be on the homepage. CNBC Television.
Yeah, I got it.
Yeah, there we go. Perfect. So as we await for JP, again, we'll be streaming this live uninterrupted. The only thing we're going to be doing on our end is showing you what's happening with Bitcoin's price action. And so stay tuned. Bitcoin is seeing a little bit of a push back up to 115.9. Where will price action go? Will we see any trade opportunities? We are on the super low time frames, currently at sitting on the 3-minute time frame. Potential inverse head and shoulders forming on Bitcoin on the 3-minute shoulder head, potential shoulder filling out, and that move. Let's go ahead and measure that move, where it would take us, depending on where this thing breaks out. Right, you're looking at a move back up to around 116.87. And so got to pay attention to what he's going to say. And this is what the markets are going to be trading, is the words that are coming out of this man's mouth. And so, yeah. Rob, any predictions you want to throw out there as far as what we could be seeing from JP or not, etc.?
Nah, it's always the same thing. I don't think we're gonna get anything out of the ordinary here, but okay. Let's see.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible and that there may be effects on unemployment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that's just That is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution. That's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a GALA poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is. So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention. Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that. But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. We're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
And there you have it. Thanks, Jerome. Appreciate it. Anyways, guys, I got as you can see, I put in a short position here on BTC. I do have a stop loss at 116.050. If the trade does not play out the way that I expected it, totally fine. We'll take a little bit of a haircut. I think it's like 22 or 23%. But a whole lot of nothing. We're looking at the data. We'll see what happens. Price, stability, and employment. So, yeah, I guess we'll find out in the next one, which is, let's check, October 29th. October 29th will be the next Fed meeting. And so what will they do then? Obviously, they have to look at data. Look at the data. Anyways, guys, thank you so much for tuning in. If you're not subscribed to the channel, make sure to do so. And we'll be back here tomorrow at 1:30 p.m. Eastern Standard Time. Gina, roll the outro. We love you guys. Thank you all. See you tomorrow. Bye.
Sin City Crypto. Cash is Cuvée. Yeah. Sin City, crypto. Everybody know we here for entertainment and info. Gonna show you how to get that big dough. So every day stay tapped in for big facts, no capping. With Bitcoin, if you're in, then you win. We divide the pie with no fraction. It's Big Rob, David. I split the game, but they gave it. Named according to your favorite. I got dry powder, why save it? To the OGs, new beginners. Special shout out to the well members. Buy a dip, sell winners. Ain't really nothing you can tell sinners. Tune in for the latest new flavors. They gonna teach us mean coins. They polarizing like barbecue chicken pizzas. I laugh with a major grin. Laggers, we trade them in. Baddies, they came to sin. And sinners gon' play to win. Screaming hola till my bags are flowing over. Hold ya to the moon, then to the solar. Won't I? Don't be letting FOMO control ya. It's over when the finger tornado close ya.